Thanks, Brad, for having me today, and welcome all you climbers. It's a great program, and I hope you take full advantage of it. My name's John Marshall, and I'm going to be talking about your pharmacy and my top 10 metrics. And we're going to go through these metrics and find out a theoretical grade. School's open. It's a time of mixed emotions. I know for parents it's great, some kids not so good, but I thought it'd be a great time to kind of do an evaluation. And this is a self-evaluation of how your pharmacy is actually doing. And really the goal here today is not really the ending grade, but hopefully it will provide you with some areas that you might need to look at a little closer in your pharmacy. So with that said, what do we, I guess I put down some disclaimers here. This is for amusement purposes only. So we are going to have fun. Don't get too hung up on what your ending scores are. And I guess it acts kind of like a standardized test. So standardized tests are good for the masses, but maybe not always good for everyone. Everyone has a unique perspective. So if you're doing things kind of differently, maybe some of these metrics don't fit exactly. We'll deal with that. That's okay. Every store is unique. I make some generalizations here. If you're doing a lot of compounding, or if you're a big LTC, your numbers will tend to be higher. If you're doing a lot of specialty, your numbers may tend to be a little lower. So just keep that in mind. And in the end, after we go through these 10 metrics, you'll see, and I think that some of these metrics uncover the same issue. They can point to an underlying issue just from different perspectives. And my final point is here, not all these metrics are created the same. I'm an accountant. I love metric number 9. So we'll get to that one when we get there. As far as what you'll need, and you may not have it available right now, but you can certainly go back and get them, is you'll need financial statements to do this. To look at metrics, you need numbers. And so if you have your year-end 2020 numbers, you would need a balance sheet and a profit and loss statement. If you have an interim period, so if you have 6 months worth, there are some calculations where you'll have to do an annualization just to kind of get a number that's straight. And then also we have one metric is tied to equip. So if you're asking me right now, what is equip? Well, you're probably not going to score too well on that one, is my guess. But having access to that will just be one of the metrics. And simply to score along at home, a calculator, piece of notebook paper, just to kind of write down your answers, and we'll go from there. So here are my top 10 metrics for your pharmacy, and this is what I would write down on your notepad. I would just keep a track of the 10, and then the number of points that you earn on each. So what we're going to do is we're going to earn a point or multiple points on each of these 10 metrics, add them up, and get a total. And then based on your total, we'll give you a grade. Sounds good? Let's get started. Now I'm going to start it off really easy, simple calculation. Number 1 metric, RX inventory turnover. So this here is basically just your annual cost of goods sold divided by your value of your RX inventory. Most of you should know this or have a pretty good idea of what this number is. A lot of people, for cost of goods sold, they'll actually use cost of goods purchased. So if that's all you have is purchases, as long as you didn't increase your inventory by a great amount, you can substitute a purchase in here. If you don't have an annual cost of goods sold number available, let's say you have a 6-month number, then just multiply it by 2 and get an annual number, estimate to give a number here. As far as this metric is concerned, here's how we're going to score this one. First off, why is inventory turnover important? It's a primary measure of your efficiency in the pharmacy. It's going to be a big measure of your liquidity because that's where cash goes to hide. It goes to hide on your shelves, and it also goes to hide in your receivables. But inventory is primarily the number 1 cost in your pharmacy. So when we look at your inventory turnover, and when you calculate that ratio, if yours is less than 7, that's really not that great. So that's where we're going to assign these points. You're going to assign yourself 1 point to this first metric. Where I'd ideally like you to be is over 13. So over 13, 12 to 13. And when you think about it, And an RX inventory turnover of 12 means that you're turning that inventory over once per month. So when you look at your shelves, you shouldn't have more than 1 month worth of inventory out there. I mean, you can order things and get them tomorrow. So why do you have more than that on your shelves? So I can tell you, over my years of working in the pharmacy business, pharmacists have done pretty well at improving this number, the RX inventory turnover. And you know why? Because they had to. Because liquidity gets tight, and where's the first place they're turning to improve their liquidity? It's to get this number down. But if you're still with an RX inventory turnover in the single digits, there's room for improvement. And when you improve this number, you'll improve your cash in the bank. All right, let's move on to the second metric. The second metric is revenue growth. Another very simple calculation. Take your last year's revenue, so 2020 revenues, subtract it from 2019, and divide by your beginning revenue, which would be 2019, or whatever period you choose to compare it. And this is just a simple measure of, am I growing or am I shrinking? And as far as perspective of grading this, I'm pretty liberal on these points here. I'll tell you. If you're growing your pharmacy by over 6%, I'm going to let you take 5 points here, the maximum. So the goal here is that you're not shrinking. You know, there is inflation. Things are going up. Wages are going up. Brand prices are going up. Now, maybe not all the generic prices are going up, but the fact of the matter is you need to grow. If you want to improve the valuation of your store, any potential buyer is going to want to see growth, and growth is good. You know, this is a good metric just to kind of look at the the top lines revenues and compare them and say, which direction am I going in? So here you can see the percentages. I'm actually being pretty honest, giving you a point if you're not growing. So I'm very liberal in that grading here. So do your calculation and see where you fall on that. Our third metric is payroll expense ratio. Very important ratio for all pharmacies. I mentioned that inventory is the number one area where cash goes. Well, the second most material place is payroll. Payroll is something you really have to manage in a pharmacy. And so what we're shooting for here on this calculation is, when you look at your profit and loss statement, is how much are you paying your employees on their wages, plus their payroll taxes, and any benefits that you're providing. So if you're providing health care benefits or 401k benefits, you got to add those in as to your payroll. Now, as far as if you're an owner-operator, I would include your wages as an officer based on the fact that if you are working in the pharmacy. So if you're working in the pharmacy as a pharmacist, I would include your pay in that employee wage number. Now, if you're paying yourself an exorbitant wage, I would exclude the amount that exceeds the market rate. So let's say, for example, you're paying yourself $300,000 to be a pharmacist. On this calculation, I would probably take $120,000 of that and include it in employee wages. The rest of it, I would exclude. That really is distributions to you. It's just the manner that you're taking your excess pay. So I would exclude any excess pay or excess benefits that you provide yourself as an owner. We're going to calculate this number, and we're going to take all the costs and divide it by your annual revenue to get a percentage. And when we look at your payroll expense ratio, ideally, I want to see you under 13%. 12% is even better. I think the NCPA average is somewhere around 12 to 13%. And so this is a real indicator of what we're going to see later on these metrics. Profitability. You really have to be lean and mean with your payroll numbers. And someone was asking me, hey, John, when should I add a tech? And I go back to revenues and I say, when you take your revenues, increase in revenues, I would divide that by 0.13 And that would give you kind of the idea how much money you can spend on a new employee. It's a simple ratio. So for instance, if you're going to increase your revenues by 1 million over a year, that would tell me that, yeah, you probably can handle about 130,000, 125,000 of additional payroll. So that's the kind of thinking you have to put into it when you have this ratio, and you can use it with actual decisions on your labor size. Now, what I love on this ratio is usually the bigger stores. So when your revenues are above 7, 8, 10, 20 million, it's easier to get your payroll ratio down lower. You have more economies of scale. So that's just one of the things that works in your favor when you're a bigger store. When you're a small store and you only have revenues of 2 million, boy, it's a lot harder to spread around 250,000 of potential payroll and still be in this ratio. So just some things to keep there. So again, we want you to be under 12 to score the maximum on this one. All right, this next metric, number 4. All right, we're going to have a little more mathematics involved here, but follow me on this one. And I think it's a really important metric, days cash on hand. This is a metric that measures how much breathing room do you have. You know, if you're checking your bank account 3 or 4 times a day, you know if you're sweating out your next wholesale bill on the 15th or the 10th of the month, how much breathing room do you have in the way of cash? So to calculate this, what we do here in this first step is kind of get an idea of how much cash are you spending on the average day. So if we look at the whole year, we would take a look at your annual cost of goods sold. So add up all that you spend on your drugs, and then add up all your operating expenses. So that would be all your payroll and all of your other out-of-pocket expenses. You can exclude depreciation and amortization. So that gives you an idea when you add all that up, all those costs, and if you divide them by 365, it gives you a pretty good average of what you spend on any given day. So when we have that average daily spend, we're gonna use that as the denominator with the cash amount as the numerator. So if you're spending $10,000 a day and you have $100,000 in the bank, that would tell me you have 10 days of cash on hand. And so that's what we're trying to get at. How much, if the cash stopped today, how long would you last? I had a guy that I was working with a couple of years ago, and he had financial problems. And he asked me, hey, John, how much cash do I have on hand? I said, well, you basically have enough until about 3 o'clock this afternoon. He had about 2 hours worth of cash on hand. So I'll tell you, things didn't end well for him. So unfortunately. So on this day's cash on hand, when I measure, what's a good number, I'd love for you to have at least 15 days of cash on hand. What's 15 days? 15 days is basically enough money in the bank to pay your next semi-monthly wholesale bill, probably pay your next payroll, and a good chunk of your other operating expenses. Sounds like in some cases that's a lot of money, 15 days, but really when you get down to it, 2 weeks is not a lot of time. So to get your maximum 5 points on this metric, I'd love to see you have 30 days of cash. So, I know that sounds for many of you to be a high bar, but, I want you to meet that high bar. So 30 days of cash on hand at any given time. And what I would say to that secondarily is not on hand, but quick access to another 30 days of cash. So if you said, John, I have 30 days of cash on hand, I would love for you to have a line of credit available at any given time for another 30 days. And that's just for the rainy day. I don't want you to necessarily use it, but in the best case scenario, if you have that type of liquidity, you can get through many of life's crises. We saw last year with the pandemic that things can dry up very quickly. I used to think that having 6 rolls of toilet paper was a good result. Now I figured kind of after last year, now I think I have 60 rolls of toilet paper around. So crises when they occur, that's when cash really becomes important. So I hope this measure is something that you can keep handy and something you can achieve and talk to your accountant or banker about as far as getting a better number. Number 5, again, we're getting into a little heavier calculations, but really not too bad. This is your non-RX gross profit percentage. So how much of your gross profits are coming from sources that are non-third-party contract insurance? And so what I have on this calculation is your gross profits from the OTC, services, and other cash business as a percent of your total gross profit. And I make a point here, if you don't have an OTC cost of goods sold, but you do have OTC sales, then what you probably can do is multiply your OTC sales percentage by 2 to give you that percent. So if 5% of your sales are OTC, then probably 10% or more of your gross profits are coming from OTC. Why is this so important? The insurance companies are setting our revenues. And you know what's happened over the past 5 years. I've seen it. Those reimbursements are shrinking. It's getting harder and harder to make ends meet if we're just solely relying on insurance companies. They're taking out more and more in DIR fees. I've seen that. Oh, it's crazy. It's robbery. It's a matter of how much they're going to rob you, not if they're going to rob you. So we need to take action into our own hands. What are the things that we can do to generate non-RX cash? Can we sell more prescription for cash? Can we focus on certain OTC line items that are really beneficial for our patients? CBD? Can we do point-of-care testing? Can we do COVID testing for cash? You know, one of the other things that really has turned into cash is COVID vaccine. I mean, there's no cost of goods sold on a COVID vaccine. I hope all of you are maximizing this once-in-a-lifetime opportunity to take the government's money. They're passing out money like crazy these past couple of years. You might as well grab your share. So in this metric, I really would love to have you get over 20% of your gross profits from non-insurance related areas. This will just give you some diversification. It'll give you that ability to build your business without reliance on the risk of the third party and what they decide to do. So look at these numbers and look at the points and give yourself the appropriate point. As we go on to our metrics, number 6, MedSync percentage. How much percentage of your prescriptions are being run through a MedSync program? When I first got started in pharmacy, this is one of the first things I learned, and I've given this speech so many times, and I really don't do a great job. I think you've probably heard other people talk about it who are experts on why MedSync. I just do it from the accounting perspective as far as if you do MedSync, things are going to be much more efficient with regard to your labor, with regard to your delivery, with regard to patient adherence. There's just so many reasons why MedSync is important. So in this case, I want you to give an honest assessment of where are you with MedSync? And ideally on MedSync, I'd love you to be over 45% of being delivered on a MedSync, and I'm setting the bar low. I can tell you I'm being easy on you because I know other speakers who will tell you 55 and higher. So, but if you're at 45, I'm going to give you full credit on this one. I'm an easy teacher on this one. Some of the other metrics you maybe didn't fare so well. So, but here, if you've got no MedSync program, I don't know what you're doing. Come on, get with the program and get your numbers up. You know, there's a lot of good tools. Everybody has a kind of a different way of doing it, and that's fine. I don't endorse any method. I just want you to do it. It's good for you. It's good for your patients. So there are the rates for MedSync percentage. Get yourself up over 50%. Let's move on to number 7, the turkey ratio. Now we're having a little more fun here on the climb. Turkey ratio. I call a turkey a bad employee. Bad employees are turkeys. Good employees, I call them eagles. So this here, I want you to take a real hard self-assessment, and really it should be a very quick assessment. You know when you walk around your pharmacy who the turkeys are. This doesn't have to be a hard, fast ratio. You pretty much know who really fits in and who's dragging you down. And this is one of those ratios where when you have a turkey, it can be one of the hardest things to correct. It really can be because you're dealing with, in many cases, employees that might have been around a long time, people that you've known a long time, but for whatever reason, they're bringing your business down. They're not a positive impact. And in almost all of these cases, they're impacting everyone else. They're impacting your eagles, whether or not you know it or not. In these cases where you have a turkey, I can tell you where an owner has addressed a turkey issue, they've never regretted it. It's been a hard address, but the aftermath is always sunny. So to find out your turkey, you shouldn't have more than 10% of your employees that are turkeys. Really, this is something. So when I look at turkey ratios, if you've got more than 25% of your staff that are turkeys, then this is probably something you're going to need to get to right away. I like to see under 10%. Really, I like to see zero. But the labor market is tight. We have certain parts of the country where you really probably can't find anybody right now, or for a reasonable rate. So you may be putting up with more turkeys than you need be. But I don't want you to just put this one aside and say, I'll deal with it later, or it'll kind of correct itself. I think action on this one always pays off. So you need eagles, and eagles will take you where you want to go. Eagles will help you correct your other 9 ratios. When we go on to number 8, your average PDC score on Equip. So this is what I mentioned earlier. Equip is a site that will tell you how you are doing. These are Medicare patients. How are you doing on adherence? Why is this important? Because DIR fees and all the plans, what are the things that they look at for an attractive pharmacy? The number one thing they're going to look at is, are you keeping your patients adherent? So the 3 main scores on Equip that you can influence on a daily basis are the cholesterol PDC, the diabetes PDC, and the RASA PDC. And each of these measures what percent of your patients are adherent, and it's pass or fail. For a patient to be adherent, they have to get their drugs 80% of the days covered. So simple mathematics. If the year has 360 days, 365 days, excuse me, 80% of those days, your patient, if they get their drug, they're adherent. If they're under 80%, they're not adherent. So there's no partial credit on this one. You want to get your people all over that 80% threshold. So when they're over that 80% threshold, it counts as a positive number, and it increases your PDC score. So these 3 PDC scores, what I would do is just take all 3 of them, add them up, get an average. And so when we look at those from a perspective of an average, I want you to be over 93%. And the Equip website will show you your state's average. And where I'm coming from in Maryland, Virginia, my state averages are somewhere around 91, 92%. So I'm really, when I say 93%, that's really not much better than state average. Ideally, you want to be in the top 20%. Now, the downside here is if all you go out and improve your Equip scores, which I hope you do, the averages will go up. The state averages will go up. But hey, that's just the way it is. So, but if you're sitting here and you have a PDC score of less than 80%, or you're in the low 80s, that's just not good. You have way too many patients that are not adherent. And with that said, on the opposite side, you're not going to get 100%. Every non-adherent patient has a story. And your job is to go out and figure out what that story is and solve that story the best you can. Some of them you're not going to solve, but some of them you are. So they're going to have a reason why they're not picking up their meds. It's either side effects, they can't afford the copay, they can't get to the store, they're forgetful. So you got to kind of wade through those things and figure out which ones you can get over that 80% number. And get your numbers up, because when your numbers are up, the plans are going to look more favorably on your store. I have a little comment here. If you don't have a lot of Medicare and you really don't have a lot of Equip, just give yourself 5 points, because that's one less headache you got to worry about. You don't have to worry about the DIR fee. So don't scrutinize yourself too much here. But most of us have Equip scores. That's just the way it is. So I want you to pay attention to that. You should be looking at that monthly. The numbers are on some kind of delay, but I do want you to look at that. It is important. So as we move on, I want to get on to number 9. This is my favorite one. I'm an accountant. What can I say? I mean, seriously. EBITDA percentage. This is what percent of your total revenues are you keeping at the end of the day? This is what it's all about. So if you sit here and say, John, I have a great EBITDA percentage, then maybe you get an A automatically. Okay. But quite often what I see is if you have a great EBITDA percentage, but you still have some low scores in these other areas that you have low scores will eventually creep up on you, and they will eat on your EBITDA percentage. So as much as this number might be your final grade in some tests, you do kind of have to keep watch on the other 9 metrics to keep this number up. So if you're not familiar with EBITDA, what I would just do is take your bottom line net income number, and I would add back interest, depreciation, amortization, and any excess expenses that you attribute to yourself as an owner that you're employing your son or your daughter for excess, or you're taking extra money out. Kind of add all that back and kind of get what your real earnings before interest, taxes, depreciation is, and then divide that by your total revenue to get a percentage. So when I look at EBITDA percentage, when I do a financial review, I always start with 5%. I want my owners to get a 5%. So when we talk about how are we going to get to 5%, I'll look at your gross margin, I'll look at your payroll expenses, I'll look at your other operating expenses, and then I'll look at what's the bottom line EBITDA. And if your EBITDA is not 5% or more, then I need to go back to one of those other measures and say, which one of these measures we need to change so that the EBITDA percentage goes up. So is my gross profit too low? Is my labor too high? Are my other operating expenses too high? So the EBITDA is the bottom line. So it's the bottom of that calculation. So when you have problems, you need to go back and find out what the root problems are. On this metric, I'll let you get more than 5 points. So if you have an EBITDA percentage that's more than 8%, give yourself extra points. These extra points and round them up. So like I said, this is my favorite metric. Take all the points that you can earn here. If you're under 2%, and especially if you're under 0, then you're doing a lot of work and you're not showing anything left over. So it begs the question of what needs to happen to get this number into the positive area. When I look at EBITDA, as an owner, you get paid last. Whatever's left over, this is what's left over for you. So this really is the most important number that you're going to see at the end of the day. And if someone's going to buy your store, this is usually how they're going to value your store. They're going to take your EBITDA and they're going to multiply it by some type of other multiplier, usually 3 or some other number, to give you a valuation. They're looking at how much they can make, a potential buyer. How much they can make on this? If I buy your store, what's in it for me? So EBITDA. All right, we are to metric number 10. Now, there were a lot of honorable mentions with regard to 10 metrics, but being an accountant, I had to put this one in here. This is my own personal bias. And this is simple. How often do you get and review your store's financial statements? Why do I say this? How can you possibly improve your metrics if you don't see them? You got to have a starting point, and then you got to have interim measurement points to see where you're going. It drives me crazy when I'm working with people and they say, I look at my numbers once a year. I get them in September for the previous year. How can I act on numbers that are that old? How can I drive change on numbers that are stale? So you need to have numbers that are done more frequently. And so when I grade you on this metric, I want you to get monthly numbers. Now, it's okay if you get quarterly numbers. And, and one thing I'll say about these numbers is you don't have to have perfect numbers. I recognize that for tax purposes, you're kind of dotting all the I's and crossing all the T's and trying to make your numbers perfect at year end for tax purposes. During the year, you don't need to have perfect numbers. You need to have numbers that you can make judgments upon and that are somewhat consistent. They're done on the same basis, and you can get a ballpark. So you know what your inventory ballpark is every month. You know what your cash is. You know what your sales are each month. So pull together those numbers. You know what your payroll expenses are each month. Pull those numbers together on a more frequent basis. Get yourself a framework and look at those numbers, and then go back and recalculate some of these metrics and figure out, am I going in the right direction or am I going in the wrong direction? You need to see what's happening. So this metric, a lot of people overlook this, but as an accountant, I don't. So there you have it, 10 metrics that kind of cross a lot of different things. But with these metrics, what I would want you to do now is kind of go through your scorecard. If you were able to do it with us along, that's great. If you have to go back and review, then do that and give you a little extra time to pull together metrics and to get the numbers together. Tally up your scorecard on a piece of paper, give yourself some points. And when you take it and you have this final scorecard, I want you to take a look at that column on the right, the points, and just kind of take a look. Where are your strengths and where are your weaknesses? If you get anything out of this speech, I want you to see, where are the areas where I'm getting 5s or more? Where are the areas where I have a 2 or 3? Because the goal of spending your time, your valuable time watching this presentation is to hopefully to come out of here and say, you know what, number 6 or number 4 or number 2, I didn't score that well. And so I need to come up with a plan of how I'm going to improve that metric. And I would say take it one metric at a time and don't overwhelm yourself. As a coach, what I would tell you to do is let's come up with some really definitive action plan items, tasks that we can identify that would help us improve a metric. Let's set a deadline. Let's assign those specific tasks to specific people. Let's review those tasks when they get accomplished. And then at some time frame in the future, let's remeasure and see if we're making progress. So that's really the goal of this. Now, when you add up all of your numbers and you get your tally, just for fun, give yourself a grade. Hopefully you're all in that A area. But I know in my household, you get a B, you're out of trouble. So it's in that C and D area that we got to have a little talk. So hopefully you have some fun. Don't fret if one category throws you off, or you say, hey, John, that category really doesn't fit my store as well. That's okay. Give yourself an appropriate grade. We're having some fun. So that is my presentation. What I would love to do now is bounce it back to Brad, who is, I'm sure he's aligned with me on measuring things. So Brad, are you there?
Hey, John. Yeah, I'm here. Great presentation. Thank you so much. I jotted a whole slew of things down here. Actually, I one of the ones, the turkeys, I had a quick story when I first started RMS. So we just turned 23. And I lost a great employee, and he said to me, this other employee, I've told you that this person is not, is a drain on us. and I gave you plenty of opportunity to fix this, and you just didn't do it. And, I have a credibility, you have a credibility problem, and I'm leaving. I'm gone. I've taken another job. I'm so happy that happened early in my career, because, as you pointed out, these people have an impact on everybody else too.
Yeah.
And so as a business owner, you have a responsibility to your team, to your patients, your customers. You have a responsibility to take care of this, and it is hard. That was firing somebody under any circumstances, one of the hardest things that you can do as an owner. But it's a responsibility. So
it's a responsibility as an owner, and and when it's over, I've never had, like I said, anyone ever say that was a bad idea. It always works out for the best, and for the person that moves on, it's usually for the best too, because it really wasn't a fit for them. It's not fair for them to be in a role that doesn't suit their skill set. So it's just not, some people aren't cut out for daily pharmacy work, and that's okay. It's okay. They're
right. Absolutely.
Yeah.
No, that's absolutely right. But it really is a credibility thing, and I think that was a really good lesson early in my career. So like you, I'm not an accountant, but I am a numbers guy, and during Climb, I've talked about the importance of looking at numbers and metrics on a regular basis. And this is just, I've never seen this presentation before, anything like it. And wow, great metrics. I'm actually gonna run this on us and just see where
you stack up. Yeah, and then
absolutely.
We'll see how that works. Yeah,
right. I might have to throw out a couple. But I think that the thing that's important there is it's something else that we teach here to our customers is, don't get overwhelmed with numbers and things. You've given 10. Look at, then pick one, pick something you're a 1 or a 2 or a 3, and identify that, and then figure out how to fix it. And sometimes you need help from somebody to fix it. Go to expertise, go to colleagues in, pharmacists, other pharmacy owners that get advice. I mean, there's lots of resources once you identify a problem area. So I would say to people, take one step at a time. Don't be overwhelmed.
I'll tell you, this industry amazes me because of the willingness of the people in the industry to share best practices and help each other. At the end of the day, I have friends that say, you have different pharmacies. Aren't they really competing against each other? Well, maybe, but they're geographically far apart, where I've seen almost everyone free to give advice to each other and help each other's out. There's a lot of resources in our industry, a lot of ways that you can get coached, a lot of continuing education so that you can improve your business. And so just use this as one of those metrics or one of those opportunities to improve your business. And if we can just, like, as you mentioned, I mentioned, you can just take away one thing that you can action upon and be specific and get help and improve, then it's worth your time today. So that's really worth it.
No, absolutely. And I agree with you. I mean, it amazes me. I tell my friends about this, what this industry is like and why am I so passionate about it. And it is that people share and try to make each other better. And I think that's really very unique. So one of the things that definitely caught my attention, because it's something that we talk about in Climb pretty frequently. It's something we talk about with our customers, and it resonates with all business owners, is cash flow. I mean, maybe it doesn't resonate with with Jeff Bezos anymore, but I can tell you there's probably a point in Amazon's time where cash flow was a problem, and it is something that resonates with people. And one of the we, of course, as a POS vendor, we're focused on the front end of the business. And I see so many people that don't look at reports for the front end to make decisions on what they should be carrying, what amount of inventory they should be carrying. NCPA shows that for front end, the average turns on a front end is 4. Right, that was just.
I don't believe that number as the day is long. I tell you, I've looked at hundreds of financial statements for pharmacies, and if you're at 2 times turnover on the front end, you're doing well. So I don't know where they're getting that for.
Yeah.
Maybe these stores are ones a couple hundred I haven't seen, but it's very difficult. So you bring up a good point. There's so much cash sitting on the shelves out there when it's only turning 1 or 2 times per year. That's a lot of dead weight, and it really does drag down liquidity for the store. Yeah. So
absolutely.
Any way to measure it or track it or figure out what portions of the OTC are selling. So you may have $50,000 worth of OTC, but only 5,000 of it is really turning. Right. So you need to know what's turning. The other 45,000 may just be dead weight that you're selling at maybe Christmas time if you're lucky, and then you're marking it down in April because it was left over from the previous holiday season. So
right. Well, and I think that's the thing that I actually wrote an article that'll be in America's Pharmacist in October. It's a CE credit on managing the front end, and one of the things that I was able to do is take some real data from one of our pharmacies and show they break down into 6 different departments, and OTC is one of them, and gift was another, and DME was another, and HBA, and anyway, but when you sorted the search or the report by gross profit dollars, OTC was the top, and gift was 3rd, and DME was 4th, and I don't remember what was 5th, but anyway, but then when you sorted it by gross profit return on investment, OTC dropped to 2nd from the bottom, and it was only 1.2 per, but DME jumped to the top. What does all that mean? What it means, and gift, which was giving 2nd to the most profit to the bottom line, was only was a GIPROI of 0.6, and so can you explain real quick what I'm talking about to customers, what that actually means?
What it means is how hard is your money working? So let's just take it, if you look at RX inventory. If you're turning it 12 times per year, let's say you put $100,000 in RX inventory, and each month you make a 20%, let's just say 10%. Let's just say 10% return on that money every month, because it's turning the entire. So you're making 10%, you sell it 12 times. That same $100,000 over the course of the year has generated you $120,000 of profit, versus OTC, which maybe has a 50% markup. So let's say you have $100,000 out there, but you're only turning it 1 time a year. That same 100,000 is only making you $50,000. And I'm being generous on these numbers, but
sure.
So it's the churn. So that same dollar invested, because it's not churning, even though the margin is technically higher at this time of sale, not giving you as much money over the course of the year. That has an inefficient use of your cash. You could use that cash elsewhere to generate more money, more velocity.
There you go. And that's, I think, such an important piece that people don't recognize. When you looked at the gift, even though it was generating the 2nd highest profit in their case, it was turning 0.6 times. So they had
not even one
what
time.
That meant is, hey, I've got way too much money tied up in inventory here. That's complete drain on my cash flow. Doesn't mean you should get rid of gift department. Just means you need to look at the department and reduce the inventory of the things that don't sell or don't turn. Right? Not necessarily get rid of the entire department. So
I gotcha. I believe.
And again, and I'm really going to end with this, but it was just, this is again a process of looking at the big picture, all of your departments, and then which ones are performing well, which ones are not, drilling down to the ones that are not, and making adjustments. Mm-hmm. So it's taking the same approach that you took with this overall metric and just applying it to a small piece of the store, which is where our focus, of course, is as a POS vendor. So, well, John, thank you so much. This has been
Brad,
terrific.
it's a lot of fun. I hope I could spread some education to. I love the pharmacy community, and I really appreciate the opportunity that you, Karen, Chelsea, and everyone at your organization gave me today to give my spiel, and I had a lot of fun putting it together. So
Yeah, great. I loved it too, and I look forward to I look forward to people doing it, and then we're hearing positive feedback. So so thanks again, and we hope to have you back at some time in the future.
I look forward to it.
Okay,
Talk to you
John.
soon. All right.
Yep. Take
Bye
care.
now.